welcome to the 10th episode of
Mo Money,
the investing show for millennials by a millennial. I'm teaching you how to be rich later, starting now. 10 episodes down. We're developing a sort of a routine here, so let's get right down to it and start with the Mo Money
Market Update.
Now, we just ended the first quarter of the year of 2016, and we are right back where we fucking started. The stock market ended 2015 at $2043.94 before it began its terrifying 3-month-long 10% plus cratering, ultimately hitting rock bottom at an intraday low of 1810 on February 11th. Since then, the market has mooed or grunted, or I don't know, what does the bull say? Anyways, it rallied back and passed that 2043 mark at noon this past Tuesday, which brings us to the next story. Janet Yellen, chairman of the Federal Reserve, and surprisingly, every Wall Streeter's recent Woman Crush Wednesday, made a speech about the current state of the markets. She announced that she did not foresee any cause to raise rates, and conditions domestically and worldwide are still nowhere near suitable for another rate hike. Wall Street rejoiced. In the final story, Apple versus the FBI. FBI somehow managed, even though they said they were fucking clueless, to crack the San Bernardino shooter's iPhone and then decided to drop the lawsuit against Apple. Great job, FBI, I guess. Now, last week we discussed what moves the price of the stock. Supply and demand, fundamentals, news, etc. Now, this week we're going to discuss taking a position in a stock. Now, there's 3 different positions that one can take in a stock: long, short, and neutral. Neutral basically means you have zero skin in the game, you don't have an opinion on the stock, you don't own it. I'm not really going to discuss that any further. So first, let's get to what a long position is. Being long on a stock, simply put, is that you own the stock. Okay, if you own 1,000 shares of Twitter, one would call that being long Twitter. This means obviously that you believe the company's shares will increase in value within some given time frame. If you watch CNBC or some other financial news network, you will often hear people say something along the lines of blah blah blah, I'm currently long the name, I see a lot of upside, when referring to a certain stock. Or at this time, I'm currently long tech. This means that they're either buying certain tech stocks or they just have a general positive view of the sector. Now, when you buy a stock or you're long the stock, the most money you could possibly lose is your total investment. No more or no less, which granted would suck, but it still is a finite amount. So let's say that you bought 1,000 shares of Enron at $80, $80,000 investment. In a few short months, if you went and took a vacation under a rock, when you would have come back, your 1,000 shares would have been worth 0. But if you took a long position in Google stock back in 2004 at $50 a share, you would be up over 1,500%. That number can only increase infinitely. That's the great part about being long a stock. Your downside is limited, your upside infinite. Now let's talk about the reverse position, which would logically be called being short. Short is probably a word that you've heard quite a lot recently, with the Oscar-winning movie The Big Short getting so much attention and acclaim. Now, let's be honest, as human beings, we are awesome at being cynical assholes. Okay, we are great at telling people that they suck and they aren't as great as they think they are. Okay, shit. With social media, we are great at telling companies that they suck. Shorting is a way to profit off of your belief that a company sucks. Okay, if you decide to short a company, it allows you to profit as the stock price of a company decreases. But it is a lot more complex than simply just buying a stock and waiting for its value to increase. So let's break it down. Shorting a stock means that you're betting against it. So what happens first when you take a short position is that you have to borrow the stock. You had a broker, you would call them up, okay, you tell them you wanted to short XYZ, they would either let you borrow shares from their firm's inventory, or they would call around and find you shares that someone was willing to let you borrow. Okay, online trading platform, it works the same. So once you have the borrowed shares of stock, your shares are then sold into the open market. For example, you decided to short 1,000 shares of company XYZ. Okay, XYZ is currently trading at $10 a share. So your brokerage account binds you the 1,000 shares to borrow, and then they're sold into the open market. The $10,000 from the sale is then deposited into your account. 3 months later, the stock is now trading at $8 a share. So you decide to do what is called covering your short. To cover your short, you simply step into the open market, you buy 1,000 shares of company XYZ at $8 a share for an $8,000 total. You take the 1,000 shares and you or your broker deliver it back to the person you borrowed them from. Okay, the extra $2,000 you pocket as profits. Great job. But on the flip side, 3 months after you start your initial short position, the shares of XYZ are now trading at $12 a share. And you can't handle the pain any longer. And you're worried that the price could keep increasing. So you decide to again cover your short. short. You step into the open market, you buy 100 shares at $12 for a $12,000 total transaction. You delivered the 1,000 borrowed shares back to whomever you borrowed them from, and your loss is $2,000. It wasn't the company, but you who sucked.
Congratulations. You played yourself.
So best case scenario on a short sale of a stock is that the company you're shorting will go to zero, meaning that you made 100% profit. The absolute worst case scenario is that the stock will increase infinitely and you'll just continue to lose more and more and more money. When shorting the stock, it is required to be bought in a margin account. Margin means you're borrowing money. So when you short a stock, it is required that you keep 50% of the total position in your account. So in the initial example, the $10,000, it is required to have $5,000 in your account. Okay, when the stock went up to $12,000, you would be required to add the additional percent to make it 50%, which would be an initial $1,000 investment. This is called a margin call. So if you really feel that a stock is overpriced and that stock continues to go up and up and up, that's fine, but you will continue to pay for it big time. British economist John Maynard Keynes has the great quote of, "Markets can remain irrational longer than you can remain solvent." As you can see, for that reason, short selling is a very risky technique. It's not something I participate in or would suggest to new investors or your average investor. It is a highly sophisticated investing strategy, and for that reason, it is not allowed in most retirement accounts. A lot of countries will and have actually banned short selling when the market is in turmoil to prevent it from declining at an accelerated rate. The great, intelligent, and admirable Emperor Napoleon outlawed short selling due to France's shaky stock market after the revolution. He called it unpatriotic and treason. And he had a point. People should not be betting against the country and its companies. Short selling was banned from the early 1800s to 1850 in the United States due to the country's young marketplace. After the ban was lifted, many people have become very rich from shorting, including Jesse Livermore, who some say is the greatest investor of all time. He made $100 million, which is a shit ton of money at the time, shorting the market before the Great Depression. Now, in defense of short selling, the selling of shorted shares can help increase the liquidity in the marketplace. It also helps to contribute to the efficiency of price discovery. Also, it helps managers to hedge their portfolios. Now, there is a way to get short selling exposure with the long position and without the margin risk. I know that sounds confusing. The way you could do that is through those ETFs that I always mention. They are called inverse ETFs, but they cannot be used to bet against individual companies, but rather sectors and indices. A few examples. Ticker symbol SH. ProShares short the S&P 500. Now, this is an ETF that you buy and will increase or decrease the inverse percentage of whatever the S&P 500 does. The S&P 500 goes up 5%, SH will go down 5%, and vice versa. Also, BIS, ProShares Ultra Short NASDAQ Biotech. Whatever the biotech sector does as a whole, this will do the inverse. Now, the third one is one of the most risky ETFs. Ticker symbol DWTI. Velocity shares triple inverse crude oil. Now, what this ETF does is it reflects the inverse percentage move of crude oil, but triple that. Hypothetically, if crude oil were to go down 10% in one day, your ETF would go shooting up 30% in one day. Now, bottom line, shorting or buying inverse ETFs can be very risky, especially for young and new investors. I suggest sticking to the strategy that has made people billions and billions of dollars since the first stock markets opened in the 1600s. Buy and hold, or be long and hold. But at the end of the day, I'm not your financial advisor, and I'm sure as hell not your father, okay? So if you want to go take the risk, it's your money. As always, Mo Money is about entertaining and, most importantly, educating. Hopefully now you understand a little bit better the long and short of investment positions. And now you may understand a little better the movie The Big Short. I know I'm not Margot Robbie sitting naked in a bathtub sipping champagne. Thank you so much for continuing to watch. As always, like, comment, subscribe, and share. Follow me on Twitter. Like me on Facebook. Until next time,
Mo Money, signing out.
Blue Frank White got sex appeal. Bitches used to go ill. Still tote still. I'm trying to see 5 mil off the single. For real. You ain't phasing the amazing. While your gun's raising, mine is blazing.
I love you, more